Hi, everybody, to Behind the Market Structure. I'm Shane Swanson with Greenwich Associates. Today with me is Jonathan Kellner, the CEO of MEMX, the Members Exchange. As everyone knows, MEMX went live this week with a small number of stocks and is going with all NMS stocks beginning of next week. So we are really excited to have Jonathan with us today. And with that, I'd like to welcome Jonathan, and we're going to jump right in. So Jonathan, how's it been? How's this starting a new exchange in the midst of COVID been?
It's been great. It's been challenging for sure, stressful I would say, but also things have gone really well, and we're super excited to be launched. Launching launching amidst COVID has definitely been a little bit more challenging than I think a normal launch would have been. For
Yeah,
sure.
to say the least. Well, looking over at least some of your metrics, it's pretty impressive. You know, if you've doubled every day, and I think even today you're already at almost 80,000 shares. So if we keep seeing that within just a few short days, I think you will be the entire market. So, but seriously, even on a small launch, it looks like you're almost getting a percentage of share in the stocks in which you're trading. So about 0.7% of a share. Is that right?
Yeah, I mean, I will tell you, we're not 100% focused on market share or volumes right now. We're really just focused on stability and connectivity. We're super excited. We've had over 40 clients connected, and we've had 32 clients trade with us. We had 25 clients trade day one, and since then we've had an additional seven. And people are starting to pick up activity. Part of launching is a lot of what we have to do is test our systems, but also our clients need to test their processes, making sure their workflow works with us. So we're in communication with a lot of those clients. Some are trading with us a little bit, making sure clearing works, and then they continue to ramp up a little bit. So all of this is kind of building up to us to be able to go to all symbols. I will tell you, probably the biggest thing I've learned is that there's nothing like the real thing. Testing, we did a lot of testing, we had UATs, we had a lot of participation, but as much as people want to participate in those tests, their real strategies, it's hard for them to run all those real strategies in test, and then for all of those strategies to come together and interact with each other. So we're learning a lot, as we go, which has been great. It makes for challenging days for sure, and some challenging nights for a lot of our team. But we continue to make great progress, and we're super excited about the progress we've made so far.
Well, that's excellent. Let me actually let's look back then, because I think it's important to understand how we got here. So, we mentioned the challenges of getting started during COVID. So you literally brought a brand new exchange to life, and the large part of that cycle was while we've been dealing with the pandemic. So, kind of tell us a little bit about how your team was able to do that. What were the challenges? What have you found to be, were there any benefits to being able to do it this way? Kind of walk us through that.
Yeah, I think like everybody, there were a lot of challenges. First of all, we were fortunate in that our company was built really with everything in the cloud. So from the beginning, we were able to work remotely. We transitioned, and before even COVID-19, we were using Zoom and Slack. So we transitioned pretty efficiently and pretty seamlessly to the remote work environment. In fact, I think it was March 11th, we decided let's do a BCP test and have everybody work from home. And then it worked well. We said, okay, everybody stay home for the rest of the week. And then we actually haven't been back since. So the transition initially was smooth. I will also tell you, our strategy of hiring has been about hiring experienced people, and that's really helped. So, the team have a lot of experience in terms of building exchanges and working on these low latency types of applications, as well as a lot of industry experience. And so having people work from home that have experience has been a real help. I would say initially, things were chugging along, and we were doing, I think we started early with the Zoom happy hours, and we did Zoom Pictionary and all those fun things to keep people, together and focused on culture. But then things start to, as people got home and they were done with their initial tasks, and we had to kind of go to that next level of task and then start integration, it became a little bit more challenging. And then also, in addition, we had some supply chain issues with some of the products that we needed, and we also had challenges integrating with vendors. We're dealing with some other vendors, and so they have their issues around COVID-19, and they're focused on things. I would say overall, again, going back to the maturity and experience of the team, it helped take care of a lot of those issues. And then over time, we just, I think as a management team, we did a good job of adapting and realizing, changing course quickly. So at times we moved to daily stand-ups, and then if we felt like that was too much, we would back off a little bit and maybe do weekly. And we just tried to make sure we kept a pulse of the organization and kept track of our progress. I would also say one thing that in terms of helpful with COVID-19 or the remote work environment was initially a lot of our clients were really focused on getting themselves up and running. And so we really stayed out of everybody's way for a little while. But once everybody settled into the remote work environment, we got great engagement from our client base. Hopefully we would have had that anyway, but it did feel like because we were able to access people, we did get great engagement. And then you come down to integration. The last, I'd say, month is definitely a little harder to do from home, working remotely. And we've had people in data centers doing work in the data centers, but it definitely is, you're jumping from Zoom to Zoom call to make sure things are working well together. But I would say overall the team has done incredibly well. Obviously, we've launched. And again, I attribute that to the fact that we've hired a really experienced set of people and a strong management team and a lot of people that are committed to what we're doing. I will also tell you, we actually have hired 30% of our staff since March 11th. So 30% of our staff I actually haven't met in person. We've only done over Zoom. So it'll be interesting to see when we all get back. It'll be nice to see everybody in person whenever that is. But we've been effective. We've been able to do that effectively as well, which is nice.
That's very impressive. And it's interesting when you say, the client engagement you've had, does it get you to the question of, okay, so why MX, why now? Like, what is, we have an environment where there are a large number of equity exchanges. They have, high quality technology. They provide a vast array of order types to the marketplace. What is the MX differential? Why do you think you had such a big, first of all, investor commitment come to MX, and why do you see the client engagement that you're seeing? What is your view of that?
Yeah, so I think, and I think you're right. Your point about the other exchanges, and we've said it from the start, and I'll continue to say it. Their technology is good. The markets are not broken. We don't believe the markets are broken. With that said, we think there needs to be more competition in the space. And I think it's just built over time. And so there's been, I think frustration around the industry, around the need for competition. And it's grown really ever since BATS was sold to SIBO. And it just takes a little time for that all to come together, which is, I think, why it's happened now. And really, when you look at it, 97, 98% of the on-exchange flow is traded by 3 exchange groups. And because of that, the industry or the participants feel like there needs to be more competition. And that's why we were able, that's why I think there's been so much interest in it. And I will tell you, it's interest beyond just our investors. And that's why I think we have such good participation, broad participation across the board. And really, they feel like, they need competition. You pointed out technology. Again, that we think the other exchanges work well, but it doesn't mean that there can't be more technological innovation. There's a lot of technologies that the street, as much as finance has been ahead of the game for a long time, I think we've really fallen behind. And so we're able to use some newer technologies, and because we're designing from scratch, we can leverage them. That we will bring innovation to the space. And I think the other exchanges can do that as well. It's just that, they're probably going to need a little bit of pressure to do that. And hopefully we are that pressure for them to continue to innovate and look at and leverage some of those technologies. In addition, the other thing competition will bring, or another thing competition will bring is pressure on fees, and that's the one that everybody talks about, pressure on market data and connectivity fees. And just in general, pressure on fees, keeping the three incumbents, honest across the board in terms of fees. And then the other biggest and maybe the biggest reason why we've had such interest is the desire for the members to have a voice in the market structure debate.
And when you talk about it, I think that's almost the idea of being in the room where it happens, right? So you have your exchange medallion now. You've actually had that, and I think you've been invited to some of those as you went through the process. Obviously, you can't share the confidential details, but can you tell us a bit about what it's like being in that room? A little bit of how the sausage is made. What has that experience been like?
Yeah, it's great. It's awesome. It's a lot of fun. No, I mean, look, you know, I don't think it's major mysteries. I think the reason to be in the room really is to make sure that the members' voices are being reflected, and their desires and their opinions are being heard and being integrated into what's going to happen. So, look, what happens in the room is as you would expect. You know, you have you have the incumbents, and then you have a couple of others that are really trying to bring other things to the debate, and we'll bring some of that new voice to the debate. And I would say, you know, in the room and just in general, I think we're aligned on a lot of things. So it's not a constant fight over, you know, it's not everything's black, you know, we're on the other side of every argument. I think we're aligned in a lot of areas, but there are certain areas, you know, things like the governance proposal that we had a, you know, file with the SEC. We worked together with the other exchanges, and everybody worked well together. Now, does everybody support it? We know they don't. You know, we know there's some legal battles going on there. So, you know, I think it's not, you know, I think it'll be, our hope is that we can continue to bring some positive change. But I think the big thing is just making sure that the voice in that room is representing the members and not just the exchanges and their shareholders.
When we talk about price, obviously one of the things that always comes to mind is the price of trading on MEMX and elsewhere, and seems that there is a bit of a natural experiment going on right now. So MEMX has your, I guess, loss leader pricing going on right now. You have Miami will be coming out with, I guess, they just announced their flat rate pricing along with their jump ball or their rates offering. So how do you view pricing of the exchange trading over time? How do you feel that will affect the incumbents, and what do you expect the response will be from the rest of the exchange environment?
Yeah. So, and by the way, I thought I was hearing it wrong. It's MEMX. You're saying MX. I just want to make sure.
I'm sorry, MEMX. Yeah, maybe I'm just lapsing on the end. MX, definitely.
MX. So the pricing, look, we've come out with aggressive pricing, but to be clear, that's really just an introductory period because we want to incent people to connect to our exchange. We want them to experience the new technology that we're bringing to bear, hopefully increasing determinism, improved interactions on the exchange, allow them to get some experience on it, get them into their routers, and then, ultimately we know that we have to meet good majority of folks have to meet best X obligations, and we just want to make sure that they can get enough data to do the modeling to then meet those best X obligations, or if you're a market maker, to model how you want to interact on the exchange. So the pricing there is to really just attract flow initially. Ultimately, we will move to a normalized pricing, and our hope is that our technology and the interactions on the exchange will be able to retain the market share gains, and will continue to hopefully grow. I would say, with MIAX coming out, it's another competitor, and we're excited. We're excited for them. Competition is a good thing. They're obviously going about it a little bit of a different way, and focused a little bit on trying to bring flow via the market makers initially, and to attract flow that way. Our approach has really been to try to bring as diverse a set of liquidity as possible to the exchange, and that's a big part of why our investor base includes market makers, as well as banks, as well as retail brokers, as well as the buy side. We really want to make sure we have everybody represented at the table, and then everybody represented on exchange with liquidity. And I think, our team has done a very good job. We've worked very hard and really focused on making sure we can have as many members connected as possible and trading with us. And so that's why we're really happy that we've had 32 already trade with us in 3 days, and I would expect that number to get up to we have, I think, close to 50 members onboarded, and so I would expect to get to that number relatively soon. And I think that really illustrates the fact that we do have a diverse set of liquidity on our exchange, and that's really how we will look to grow what we're doing.
You've mentioned a couple of times this idea of determinism, and how that's a differentiating factor for your exchange. Explain a little bit more about that. Why do you feel that's a differentiating factor, and how that compares to others, or at least how it brings yours to the forefront?
Sure. I mean, to oversimplify it a little bit, really it's just about having consistent behavior on the exchange. So when you send an order and then you send a cancel, you want to make sure you get that cancel back it consistently throughout the day, in the same amount of time it takes to get a cancel. You want to make sure when you send an order and you expect to be a certain place in the queue, you're in that queue consistently, whether it's a busy time of day or not busy time of day. What does that mean for participants? If you're a market maker, you want consistency so that you can manage your risk. If you have consistency on our exchange, you can manage your risk at all times. You're going to be willing to make tighter markets, hopefully bigger markets, deeper markets. If you're an algo provider and you're interacting with the market, you want to focus on the alpha that you're retaining or attaining for your client, as opposed to the nuances of the different ways it's going to behave on the exchange at different times during the day. So we think by increasing determinism, overall, all aspects of the market will be improved. The market makers should be able to make better, deeper markets, and the people interacting on the exchange will be able to focus on their value add, as opposed to focusing on the nuances of the technology at the exchange. How that compares to the other exchanges, all I can tell you is what our investors and our members have really asked us to is really focus on determinism and increasing determinism. And I think it's why I really focus. We are using, I talk about us innovating via technology and using the latest technology. It's not an arms race to be the fastest. We will be as fast as anybody else, but that's not where we're differentiating. That really is, that battle is really over. For us, it's about determinism and making sure there's consistency, and then leveraging the technology to reduce costs. And that's really where we're focused.
Excellent. And I understand that as well, you're keeping the order types relatively straightforward as well at this stage. I don't know, do you have any plans to enhance that over time, or is it right now it's all focused on just providing straightforward experience with determinism, with the speed that's required, and worry about future enhancements later? Is that where the focus is?
Yeah, so we went about a simplified market. Again, it's what really the investors really asked us to do. We want to simplify the market. Simplifying the market also reduces the complexity of the technology, so it makes the technology a little bit more efficient as well, and keeps it simpler and probably and a lower cost base. Ultimately, and we didn't just pick it out of the air, though. We spoke to all of the investors, and we believe they represent all of the members, to make sure that we were capturing what they needed. A lot of order types have come about because of technology limitations along the way that probably could be gone, or could be removed. And really, that's where we came to, where we were able to reduce the amount of order types we have. With all that said, the only way to know if this is really going to work is to go live and see where we are. So to tell you that we'll never increase the amount of order types, I can't. If we achieve what we're trying to achieve with this model, ideally, and my hope is that we don't have to increase order types and do anything unique. We would like to keep it as simple as possible. With that said, I think we have a great investor base around the table, who have an incredible amount of market structure and expertise. And if things aren't moving along as we would like, we will continue to talk to them about, okay, what can we do to enhance the market that makes sense, that doesn't also move away from our mission. And so no intentions of increasing any of that, but that's also dependent on if we continue to grow share or not, and achieve what we're looking to do.
Of course, makes perfect sense. One thing I did want to mention, we do have the ability to accept questions. So while everybody is participating, if you want to submit a question, we will try to answer those as we go along. Do have more to cover, of course, but so everyone is aware. I do want to talk, since we have you, a bit about the overall market structure. That there are some inevitable questions that arise. One of which is already been addressed a bit in the SEC's infrastructure and governance changes, the overall Reg NMS 2.0 debates. So we have the infrastructure, the infrastructure filing from the SEC kind of working its way through. What is your view on that massive filing? What is the thought around the SIP's place for market data? I saw actually, I think today it hit the register that you will be using the direct feeds from Miami for part of your routing when you get to routing, but you'll also have using SIP for the LTSE. So clearly SIP is important in a lot of different ways. Having a distributed SIP is a massive undertaking. Infrastructure filing is a large thing. That's a terrible question. I'll drop it there and let you go.
Yeah, so I mean, the infrastructure proposal is very large. So it's probably the easiest way to take it is to break it up. I think the adding odd lots to the quote, I think has an incredible amount of support and makes a lot of sense. I think, and hopefully they will move forward with that. I think the challenge there is the question of whether to protect it or not. I know that there were a lot of letters in opposition to not protecting the odd lots, and that complicates the market, having a protected BBO and an NBBO, PBO and an NBBO, and it gets confusing. My hope is that the SEC will come around on that. But we'll see. They're obviously reviewing it right now, but hopefully they will listen to what a lot of folks have said. Ultimately, if they want to do something with OPR, I think it should really be done separately. They need to do a full analysis and figure out what to do. I'm not saying they should or they shouldn't, but I think to couple it here overcomplicates it. It would be really nice to make some progress. And so I think if they were to just say, okay, let's add odd lots and protect them, I don't think it's major changes for people. And I think, I'm sure there are some changes, and there's definitely other opinions, but that's where we feel like we could make some good progress. In terms of the rest of the proposal and around SIP and competing consolidators, we'd like to take a little bit of a step back on it and really what's the goal here. And the goal is really, you have really a two-tiered market, if you will, in terms of people that are able to get data. That you have the SIP, which is a little slower than the direct feeds, and it doesn't have as much content. And so they proposed, they suggest in the proposal adding some content to the SIP, and then also having the competing consolidators, and maybe that will do something. Again, I think we want to take a quick step back and just say, ultimately, what are we trying to do? If the goal is to not have a two-tiered market and have equivalence across what would be a SIP and a direct feed, if we should focus on the data coming out for both feeds, for all feeds, and the way the data is distributed for all feeds to be consistent, and not mandate those two separate things. And then you have the consumers of that picking and choosing. People will create products based on what people want. If you just want top of book, someone will provide you top of book. If you want 5 levels of depth because you think that's the right number for you, someone will provide you. Sorry about that. 1 second. There's a phone going.
No worries.
So what happens when you work at home and one of your kids' phones is stuck in your room. If you want 5 levels of depth, you will take 5 levels of depth. If you want the full depth, you can get it. If you want, auction data. So, and you can see in our comment letter, we tried to get to that where we think as an industry, we should take a bit of a step back, and the SEC should take a bit of a step back and say, what are we trying to achieve, and what's the right way to achieve it without, like creating extra complication. Some of it, we think competing consolidators are a good idea. And we do think more data should go into the SIP, but we think you could solve it by looking at it from the way we're looking at it, whereas, and how we look at a lot of things. Like let's let's ask why we did this from the beginning, and not just say, oh, we do this just because we do it and continue. We've done that with a lot of our technology, and we think we've made great improvements because we ask that question all the time, and then try to figure out, okay, what if we were designing from scratch, how would we design it? Now, all that said, I don't know where they're going to come to. I mean, they're obviously looking at it, and so we eagerly await to see what the next steps are.
I think that's fair, and it's an interesting time, of course, as we come up on an election cycle with the commissioner's term likely coming to an end. So, to your point, do you feel that there's a pressure from internal at the SEC to make something happen? Is there time to step back before a decision comes out? I guess that's just an open debate, but it'd be interesting to hear what your thoughts are.
Yeah, I mean, I have a feeling there was so much in that proposal because they really wanted to get a lot done before any change will happen. I just think it's going to be incredibly hard for them. I'm sure they're working very hard to try to get as much done as they can before any changes. It's hard to speculate on, these things I mean, even the governance proposal, which, the governance order, which is really, much narrower, and I think probably less controversial except for some of the exchanges. Even that's taking time, and it will take time. There's still a process that has to happen. There still has to be a comment period there. So I don't know that anything gets official. They may try to put something out and get it kicked off. I would assume they're going to try to get something out and get it kicked off before any changes in November, and then who knows.
I think that's fair, and that comports kind of with our understanding and belief as well. There's obviously a lot of other stuff going on. We have a interesting challenges coming up for the industry, I think, with financial transaction taxes. The specter of that keeps getting raised. So most recently, we saw a lot of debate out of New Jersey. So the state legislature picked it up. It was debated fairly vigorously. It didn't make it into their 2021 budget, although I hear that was just put aside for the official budget, and it may get picked up in a supplementary procedure. What are your thoughts on FTT? How do you think it might affect the industry? What are the state ramifications, and what about federal FTT? Again, a wide-ranging topic, but I'll let you pick that up.
Yeah, sure. So I will say I think that's one area, again, where we as an industry need to work together, and we are working together. We are part of a coalition with the other exchanges, as well as many clients, interested parties in what would happen if there was an FTT. I would say first and foremost, when you look at an FTT, we need to, as an industry, explain to the politicians that this is, I know it feels to them like it's Main Street versus Wall Street, but it's really going to hurt Main Street more than it's going to hurt Wall Street. And so, ultimately, this is going to get passed on to the end investor, and it's going to hurt the end investor. You have to listen to the facts to know that that's the reality. And an FTT headline, knocking Wall Street is an easy one as a politician. So I think we have our work cut out for us, for sure, to try to get that done. And I think that's why it's really good that as an industry we're coming together to try to fight those things. And there's the fight. I feel like it's a fight on multiple fronts. Because the federal one's always been there. It's quiet now, but depending on what happens in November, it's probably going to pick up. And obviously, all of this is because the states and the federal government are definitely strapped for cash. There's no doubt. But I think the other things that we have to focus on when you get to the state, the state types of taxes like New Jersey, the industry is portable. There's no doubt, and we're trying to explain that to them. I don't know that they believe it. I'm sure one of the challenges I think they have is anytime a group looks like they're going to get a tax, they go threaten to their government to say, hey, we're going to leave. Their state government to say we're going to leave the state, but it's usually harder to do. For us as an industry, we don't have to be near New York. We can be anywhere. Just ideally, we all have to be near each other, and so that's why you've seen, we're doing this big test. We've moved up a test this weekend for Chicago, and then we have another one in October. And everyone is participating to try to make sure that we can at least prove to them that we can go, and then potentially be ready to go. The other thing, another thing that the state taxes do present potential problems with are legality of it, and that's, to your point, why it didn't go into the budget we think it didn't go into the budget at the end of in New Jersey budget, this budget, because they have to know that they can or they have to be somewhat certain that they can get the revenue, and they know there's going to be a legal battle because there's investors all over the country that are now getting taxed on something that's happening in New Jersey. There's going to be fights all over the place. The supplemental tax that they could put in October, I believe, doesn't have to prove that it can actually capture the revenue, so they can put it in and then worry about whether they're going to be able to gain that revenue or lose the legal battle. So we still have a fight ahead of us. I think the New York New York tax, there's talk of it again. It's on the books already. It's just
Right.
they don't impose it. And then I would just say the other thing to look at just in general for all of us is that there's real world examples of how these FTTs don't work around the globe, and they've been put in place in the past. And so again, I think it's on us as an industry to just make sure we're out there explaining it to people so that this Main Street versus Wall Street battle is clear, that this is not an opportunity to really hurt Wall Street that they think they're trying to do, and it's actually going to hurt Main Street.
Yeah, we've actually done some research at Greenwich, and it follows along those exact lines. And again, it's unfortunate because it does get couched in these terms of us versus them. And unless you really do peel back that onion and understand that where does it actually impact, how does it go down the kind of the waterfall of impact, it does end up getting passed along really to the retail, to the long-term investor, and to the intermediary. It's just a pass through to the long and short of it. We did have some questions. Oh, please go ahead.
Sorry, and even in this, just to that point, even in some of the conversations with the politicians, they a lot of times they don't believe that because they think, well, you say that, but in order to compete with each other, maybe one of you will eat it, and then the rest of you will end up eating it and won't get passed. And they just don't understand that there's just not a lot, all of the revenue that the exchanges make actually is less than what they're expecting to generate from the tax. So the economics of how the market works, they're not quite getting either. But
right, yeah, well, again, it's in particular when you are dealing with people who don't understand the industry itself, and you have to do a lot of education. And so you have to educate the legislators, you have to educate the public in a lot of instances, because again, it sounds so easy. We just want to charge a little bit on the fat cats, and you'll suddenly get this windfall to pay for this huge deficit that, again, cities, states, and the nation has experienced as a result of COVID and other reasons. So it's understandable, but we have to be prepared to challenge it where it makes sense. Interesting, we did get a question on data centers, where MEMX is trading out of.
So we're out of NY4 in New Jersey, and then our backup is in Sixterra in Chicago and Cermak, and then we also have another local backup. So that's our geographic backup in Chicago, and we have a third data center in Weehawken. So yeah,
very good. We have another question as well around success in terms of metrics over a longer time frame. So in 3 years, where would you find in terms of market share? What's a success metric, if that's something you're comfortable with kind of forecasting? What are you looking at there in terms of what's the right level of market share that you are hoping to hit in that time frame?
Yeah, so I'm not going to put out an exact number, and I don't think there is an exact number, even if you were to ask, a board member what it is. We want it to be meaningful market share so that our voice is heard, as well as, obviously be a profitable business. What I would say is we are competing for about 45% of the market right now. So we're competing for that intraday maker-taker market share, and that represents about 45% of the market. And when you look at the exchanges that are doing that, they vary. The market share of each one of those medallions varies from anywhere from like 5% to double digits. So I would say success would be somewhere in the middle there. Great success would be at the top, and poor success would be at the bottom. But that's really what we're looking at, and how long it takes to get there and where we are. That's just for if you're talking about just the U.S. equity, our first U.S. equity medallion.
And I think that's a great segue. So when you think about what else you might attack, so obviously you're just getting started, you've just launched in the US in equities. Larger plans, do you have any thoughts on what might be next? Are there other assets, other geographies? Where might you see this technology could take you?
Yeah, we're just trying to get to Friday at this point in time, but I will spend a little time thinking about.
Get to the end of the week, sure.
Exactly. So yeah, look, we have an incredible set of investors around the table that represent and trade, any liquid asset around the globe. We've built a great team, and I think we've built great technology. So it would be probably, it would be a shame to just do U.S. equities alone. With that said, we have been really focused on getting launched, so we haven't spent a lot of time on what it would be next. I can tell you that the time we spent a little bit thinking about it, the obvious ones are, options in the U.S. because we already have the medallion. The equity medallion can be extended with a rule book. And then obviously building out that we'd have to enhance the technology. We could go to another geography in equities that from a technology lift would probably be not as difficult, but obviously there's many other hurdles there, especially with COVID-19 now and no travel. That would be a real feat if we could launch an exchange and never go there. That would be interesting, or never go overseas to do it. But that doesn't mean other asset classes. I think we would look at other asset classes as well. What I would say is our focus is going to be on areas where we can leverage our technology, leverage our expertise, areas where competition is needed, and technological innovation can be a benefit to the market. And that's, I think, so as we look at other things to do, we want to understand that it makes sense to go there from our investor perspective as members, and then two, from a profitability of MEMX. It's really important to know that when the investors came together, they were very clear that this is a for-profit business, right? So, and we think it was a really important decision because our ability to attract the talent that we want to attract, you need to have that right incentive. So we want to be in places where we can bring change, but we also want to make sure that they're adding value to the MEMX, as an entity.
Excellent. One other topic that's been very hot has obviously been in retail trading. So you have huge retail firms that are part of your investor base. There has been an explosion of retail trading. I've heard estimates that, at the height in 2019, retail trading may have been 10% of the marketplace. During 2020, it's, 20% plus of the market in U.S. equities. How has that impacted, the volumes? How does that impact the way the SEC and others look at the market? Are there dangers or concerns about having that much retail trading where there hasn't been that much before? Just what are your thoughts around that kind of explosion of that market segment?
Yeah. I mean, I think it shows you that the markets are working as they should be. I think it's great to have just more people participating in the markets. It's why we battle over the SIP and direct feeds. We want market data to as many people as possible so that we can have as many people as possible participating in the markets. I think the market structure that we have, the fact that retail doesn't pay, their fees, it's free to trade, is a testament to what we've built as an industry, and I think it's great to see that grow. The other side of it is there's a lot of trading going on off exchange, and so it's something that I think we should be aware of. I don't think it's necessarily bad in and of itself. We just have to always keep an eye on it to make sure that the right price discovery, the right liquidity discovery is possible. There's always going to be a little bit of a push and pull between the different constituents in the market. Is it perfect for retail? Is it perfect for institutional? And so you want to keep an eye on that, but we don't want to, shoot ourselves in the foot and do something that hurts retail and suddenly all that retail flow goes away. We really want them in the market. I think it's good for all of us. There's nothing specific that we're doing for retail. We do have some of our investors are obviously retail brokers and some of the wholesalers that service that flow. But again, we are trying to build an exchange for all, and we have nothing specific to that no specific retail order types. With that said, it's an area that I think we will obviously continue to look at and work with both sides, retail brokers, wholesalers, buy side, just to make sure and think about, are there ways that we can continue to improve interactions or increase interactions, and in all cases to make sure that that retail flow continues. But if there are ways that we can do things to help it grow, that would be great. But I do think it's a good thing. I would say there's talk about I think sometimes people are trying to put them in a corner, like they're all gamblers, and it's a negative. And I think it's really important for us to not, like, we should be happy that they're here, and we should continue to help educate them and continue to provide a market that works for them. And I think part of why we fight the FTT is to make sure that we can continue to help retail grow. And the more people we can have participating in the markets, the better it is for all of us.
Yeah, without a doubt, the explosion, certainly there are areas of concern, I would say, when you have bankrupt stocks that see a ton of flow that may not turn out the way people are hoping, right? That's education becomes really important, right? I think that's always something that as an industry we can do more of. We need to make sure that that is forefront of everyone's thoughts. But on the flip side of it, I've said it before, and I'll keep saying it, it's never been better to be a retail investor. You get the tools that, a decade ago, the most sophisticated of investors, now a retail investor has them on their phone. They trade for free. We all know that nothing's really free, but the commission is free. The experience is immediate. There's price improvement. There's all this, there's a slew of things that are extraordinarily good for the retail investor. So I think there are a lot of positives. We just need to make sure that on the educational front that they're aware of, anytime the risks are apparent when they're out there. There's another couple more questions, and we're coming up on our 45 minutes, so I want to make sure we get to these. There has been a question as we were talking about the possibility of moving away from kind of the current centers of gravity for New Jersey right now for the market centers. If there was going to be a move out of New Jersey or out of Chicago, where would you see some of those other areas of possibility? I've heard places where there's tons of land and available space. For Texas, Utah, South Dakota have been thrown out. I don't know if you have any thoughts there.
Hopefully somewhere warm. No, look, I think there's some governors lining up, I think to try to attract our industry to their state. So I think, I don't know where the most likely place is. I mean, it could be, Florida, Texas, Connecticut. I don't know. My hope is that in the end, we don't all have to move. I think it creates, there's risk around the liquidity. One of the risks here is just, liquidity is great. The spreads are in a good place. We have our issues around tick sizes and things, and we can continue to improve our markets. But as you said, retail hasn't ever had it better. And, so I think the markets are working well. Once you start moving, you create uncertainty, you create risk to all of that. So I think ideally we don't move. To say where we would move, I think it's completely up in the air. And I think that, I think that's what's interesting. And I think that will be, hopefully the the legislators, politicians will come around and recognize that and say, what, it's actually good to have you guys here. We use a lot of energy. We have some jobs, not an incredible amount of jobs, but it's a good thing for the state. And it attracts data centers, things like that. So
I think that's fair. There's another question in terms of potential conflicts. So, and there's a lot written about this in the retail space in particular. There's payment for order flow, which again is I think perfectly acceptable method of garnering order flow. It's fully disclosed, but there's a lot of it out there, and now there's more disclosure around it. So I think there's been more discussion about it. There's ownership in exchanges. There's rights offerings under Miami. How are conflicts handled by order sending firms these days? What are the ways that those are managed?
Yeah, and we obviously focused a lot on that early in terms of the right makeup of investors to make sure that we had a diverse set of investors. So you know, in terms of getting liquidity on exchange, we do have some market makers who trade proprietarily who don't have those best X obligations, which is a good seed of flow. But you are correct, a good majority of our investors and just members as a whole have best X obligations, and that's first and foremost. So from the get-go, our focus has been around providing an experience on exchange that they will be able to meet their best X obligations. How that works is, you know, fortunately for us also. So, you know, if you compare us to like when BATS was launching, it was definitely a different time and people could move flow a lot easier. Now it's definitely more focused on best X, but at the same time, because of these conflicts of interest have been raised over the last few years, most members have a pretty robust and set policies and procedures around how they manage the best X. They have best X committees. They have analytics that they're looking at, and you know, we try to understand them, but they're not going to disclose everything because that's part of, you know, they don't want anybody gaming the system. But they're looking at, you know, fill rates, markouts, you know, and each, I would say each queue depth, queue lengths, each client is different. We've had several meetings with, you know, the different folks that are doing the routing, and each one has a different twist on it and a different opinion, a different analysis on what is important to them and what goes into their best X committee. But I would say, or best X, you know, decisions and routing decisions. But I feel like we're actually in a really good place in that over the past few years, there's been so much focus on that everyone has really set policies and procedures around how they deal with it. And so, you know, and part of why we want to go share, that's another driver for some people. You know, if they don't, if they're trading 10% on MEMX and we're only 2% of the market, then their best X committee is going to say, wait a second, why are you doing so much more? Now, it doesn't mean they won't. They're going to have to bend over backwards to prove execution quality, but it is one of the factors that a lot of people look at. So I think we're actually, you know, in a good place, and we've talked to all of our members, but you know, a lot of our investors, in addition to the members, pretty consistent from a member to non-member to investor to non-investor in terms of how they're going to interact with us initially, how they're going to evaluate it. And so I think it's because those policies and procedures have been put in place, and people are sticking to them and will.
And I think that's great. And I do think, again, there's been the fuller disclosures that have been mandated. I think, again, there's been a lot of eyes on it. The discussion and what is it, you know, sunlight's the best disinfectant in some ways. The fact that everybody is able to see it, it is public, we're all aware of it. You know, 10 years ago, people wouldn't have talked about it. Now it's just very much up in front, and firms know what they have to do to be able to justify what they're doing. And I think that's been a good thing and has ended up, again, increasing the quality of the analysis and the executions that are received on the back end.
Yeah, I think it's gotten us to a much better place. And I will also say, I don't, you know, we get the question sometimes, but we haven't seen a whole lot of people saying we don't, you know, not, you know, having concern around it with our investors.
Excellent. I don't believe we have any more questions right now. We are a little bit over our time. I want to thank you, Jonathan, for joining us today. I think it's been a great discussion. Really appreciate everyone who has joined us as well. If there are any other questions, you can always reach out to us. Once more, this has been Jonathan Kellner and Shane Swanson. Thank you very much for joining us for Behind the Market Structure. Thank you all. Have a great day.
Bye-bye.
Bye-bye.